Imagine this. You get hit with a surprise medical bill that wipes out your quarterly profit. It's terrifying, but here's the thing. It doesn't have to ruin you. Today, we are uncovering powerful legal tax strategies that small business owners often overlook. Strategies that can turn your health costs from a burden into a deductible asset. Stay tuned, because by the end, you'll know exactly which moves to make, even if you are a solo entrepreneur or have a small team. So let's dive into it. The first health-related topic that we want to talk about today is self-employed health insurance. And so self-employed health insurance is basically just paying for insurance and you're just a self-employed individual. So whether you own a sole proprietorship, whether you pay an S or you own an S corporation, if you're paying personally out of pocket, not through some other employer, but you're paying for your health insurance and you are a business owner, it is tax deductible no matter what. So that is one thing to think about. Now, when we talk about self-employed health insurance, there is a special way on how we get the deduction for that self-employed health insurance. So if you're just a sole proprietorship, a single member LLC, you're going to take that deduction on your personal tax return, Form 1040 on Schedule 1. So sole prop, single member LLC, super easy. Pay for those premiums out of pocket and then take that deduction on your personal tax return on your Form 1040, Schedule 1. Now, if you are an S corporation, there's a few hoops that we have to jump through to make sure that we're getting a deduction for that health insurance. And it's important to follow these hoops, because if you don't do this properly, if you just do it, take it on your personal tax return, your 1040 on Schedule 1, without going through these first steps, you could lose the deduction. So the hoops with an S corporation, and we're going to talk about why this is also a really good thing for an S Corp owner. But the first thing is you're going to want to have your S Corp pay the premiums. If you already have paid them personally, use an accountable plan to reimburse yourself for those premiums so that your S Corp is paying for those health insurance premiums. The second step is you need to add those premiums to box 1 of your W-2. Now, it's not going to get hit with FICA taxes or Medicare taxes, box 3 and 5, but it needs to be added into box 1 as the S Corp owner. So you're going to pay the premiums through the business, take a deduction for it, add it to W-2 income, and then you get the deduction on your 1040 on Schedule 1. So you're getting the deduction in the same place as you would if you were a sole prop or single member LLC. You just need to add that to your W-2. Now, here's the really good thing about that. Everybody knows, if you've been listening, if you've been watching us, everyone knows that you need to take a reasonable salary as an S Corp owner. Now, the bad side about that reasonable salary is it gets hit with FICA taxes. And so that's Social Security and Medicare, roughly 15%. But with the health insurance premiums, they do not get added to box 3 and 5, which is FICA taxes. So you don't get hit with FICA taxes on your health insurance premiums, but it's part of your reasonable salary. So let's say that your reasonable salary is $60,000 for your business and you have $10,000 in health insurance premiums. You'd only need to run a reasonable salary of $50,000 because we're going to add that $10,000 in health insurance premiums to get you to the $60,000. But we're only paying FICA taxes on $50,000. That's the beauty, and that's a really good benefit of being able to do this. So sole proprietorship, single member LLC, take a deduction, personal tax return, Form 1040, Schedule 1. S Corp, pay the premiums inside the business, add it to box 1 of your W-2, and then take the deduction on your personal tax return, Schedule 1. If you are working with a payroll provider like a Gusto or something like that, talk to them about this because you need to make sure that you're doing it correctly within the payroll software. Very important to do that correctly. Now, if you're paying for insurance for non-owner employees, you still obviously get the deduction for that, but you're going to do it a little bit differently. We're going to be adding it in different pieces on the W-2. For that, for non-owner employees, you're simply adding it to their W-2 box 12 with code double D. So just keep that in mind regarding self-employed health insurance. The next thing I want to talk about is a health savings account. And guys, a health savings account is something that I think everybody, as long as you qualify, every single person should be taking advantage of it and maxing it out to its fullest. I'm going to talk about that why in just a second. But first thing about a health savings account. In order to qualify, you need to have a high deductible health plan. But a health savings account comes with what I call a triple benefit. You get a tax benefit when you put money into that account. You get a tax benefit on any growing inside that account is tax-free. And then you get a tax benefit when you withdraw. You don't get taxed on the withdrawals as long as you use it on qualified medical expenses. And that's very important. You get a deduction going in, tax-free growth, tax-free withdrawals. There is no other account that the government gives us like that. Roth has tax-free growth, tax-free withdrawals, but you don't get a deduction going in. A traditional retirement account has a deduction going in and tax-free growth, but you don't get tax-free withdrawals on the back end. a health savings account, you get the triple benefit. And so a strategy that I often talk to people about is to say, hey, let's fund and max a health savings account and think of it like a secondary retirement account. Try to not touch those funds. Invest those funds, get them to work in there, but try not to use them. So let's say medical expenses are coming up, you're paying for it out of pocket, you're fully funding your HSA, and you're paying for those medical expenses out of pocket, you're not using that HSA, you're letting that HSA grow. Why? Because of the triple benefit. Deduction going in, tax-free growth, tax-free withdrawals. And then when you get to retirement, guess what? We're all gonna have medical expenses at some time in our life. When we get to retirement, we can take the tax-free money from a health savings account to pay for those medical expenses instead of digging into maybe taxable retirement accounts to pay for those medical expenses. So biggest thing is I recommend with a health savings account, treat it like a retirement account. Try not to touch those funds. But here's the good thing. If you run into a tax crunch, let's say you're funding an HSA, not using it, paying out of pocket for all medical expenses, and then 6 years down the road, you get hit with a money crunch where you need some cash. Well, guess what? You can take those receipts from those 6 years, submit it to your HSA for a reimbursement, and get that money at that time. Again, tax-free as long as you have those receipts to back that up. So super powerful there. The biggest thing is if you're doing this strategy, make sure you're investing the amount in that health savings account. So many people don't realize that step, skip that step because they're just so used to putting money in, using it on expenses, draining it, putting money in, draining it. If you're using this method to keep it growing, letting it grow tax-free, make sure you're investing within that health savings account. Key point. Now for 2025, there's two limits. If you're single, the max you can put into an HSA is $4,300. If you're married, it's $8,550. Again, everybody, if you qualify, I believe should be maxing out an HSA. Now, if you're over 55 years old, there's an additional $1,000 that you can put in there as well. The other cool thing, and this gets a little bit complicated, we talk about this a lot in TaxAm and help guide people through this, but there is a planning technique with an HSA if you're an S-Corp owner where you can add it to your reasonable salary. Similar to what we talked about with self-employed health insurance where it only goes in box one, not gets hit with FICA, you can do the same thing with an HSA. A little bit trickier, payroll companies aren't really used to it, so a couple workarounds on that, but there's definitely a potential there you can talk to with your payroll provider. Also, hey, quick heads up for business owners who are sick of paying tax roulette. We just dropped our brand new tax savings starter kit, and yep, it is totally free. Inside, you'll get our master list of write-offs, you'll get behind the scenes case studies of business owners saving $5,000, even $25,000 and more. And you'll also get a bonus discovery call with our team to help you spot missed opportunities. Go ahead and grab it now at taxsavingspodcast.com/starter kit. That's taxsavingspodcast.com/starter kit. All right, back to health strategies. So the next thing we want to talk about is business owners that have high medical costs. So business owners that have high out-of-pocket medical costs. Of course, insurance premiums and the HSA, you get a deduction for that. So this would be for costs over and above your health insurance premiums. If this is you, there is opportunities for planning here. Typically, we're saying once you have $5,000 or more out-of-pocket health costs, so $5,000 over and above your health insurance, out-of-pocket health costs, and if you have a business with no employees, there's planning there. It's something called a Section 105 plan. And with a Section 105 plan, there's the opportunity to turn medical expenses into a valid business deduction, but it's got to be done correctly. These things are fairly easy to put together. You just need the right documentation and you need to dot your I's and cross your T's. We provide all of that in the TaxHelp platform. So again, this would qualify if you have roughly $5,000 or more of out-of-pocket health costs. That's over and above your health insurance, and you have no employees. You might want to look at a Section 105 plan where we can turn personal medical expenses into a valid business deduction if you do it correctly. The things you need to do is you need to ensure you have the correct paperwork and a plan design, and that plan design is going to be key, making sure that we're following that plan design. But then basically you would reimburse the employee, which would be you or your spouse, depending on how we set it up, for medical costs incurred. Now, depending on the way your business is set up, if you're single or married, or you're a sole proprietorship, or you're an S corporation, or you're a C corp, depending on the way you're set up will determine the best way to set up a plan like this. So it's not as easy as just putting the plan document in and making that reimbursement. There is a couple steps. There might be another entity involved, depending on whether you're single, married, how your current business structure is set up, but it can be a super powerful plan, especially for those that are going through high medical costs at this time. Now, the next thing I want to talk about is health benefits if you have employees. So now we looked at options without employees. Now if you have employees, when we talk about health benefits with employees, I really try to kind of bucket or put into a bucket a few different options of what you can do. You can do group health insurance. First bucket is not offer any health insurance. Of course, that's an option. The second option would be group health insurance. You could increase wages to cover the cost for medical costs. Now, the problem is that's gonna be taxable to the employee. So basically you'd say, okay, your typical wage is gonna be 50,000, we're gonna give you 60, and that's just extra money. We're gonna pay you extra than we normally would an employee to cover health costs. The problem is that's taxable to them. The third option would be to self-insure or some variation of self-insurance, or an HRA, a health reimbursement arrangement, or a QSEHRA, or an ICHRA. And so I'm specifically going to talk about HRAs because a lot of times, especially for those smaller businesses that we're talking to, these are really good options to be able to offer a health benefit as a small business without having to get into this massive group plans or anything crazy like that. So if you have less than 50 employees or even closer to like 25 employees, I love the idea of using a QSEHRA. That's QSEHRA. So QSEHRA. And then if you have more employees than that, you can also look at an ICHRA. That's ICHRA. But basically with a QSEHRA, you reimburse employees tax-free for medical expenses, including health insurance premiums. It's a business expense to you and it's tax-free income to them. So this is why it's so much better than just saying, hey, I'm just gonna pay you more, because that's taxable to them. With a properly set up QSEHRA, you're saying, hey, we're gonna set up an allowance that we choose that's generally going to have to be the same for all employees. All employees are going to need to have similar allowances. It's going to have to be available to all employees as well. But we're saying, hey, we're going to give you up to X amount of dollars per year, X amount of dollars per month, and you can use that to cover medical costs. That might be go to the marketplace and get a health insurance plan with that. That might be funding various different accounts. So this is the thing that we need to set it up correctly. They need to have proof of expenses. So they need to prove that they're using this for medical expenses, but can be a super easy way to be able to offer our employees health insurance benefits within our business without getting into some complex, crazy expensive plan. Now, obviously, run the options. There's a lot of options when it comes to health, so run the options and see what makes the most sense for your business. But just know that this QSEHRA is a really good way to get your feet wet. I talk to so many business owners that say, Mike, I just don't want to hire employees because I have to do all these benefits and retirement plans and set up health insurance and all these other things. Well, there are a lot of plans, and retirement goes the same way. There are a lot of options where you can dip your feet into it and offer something that's not going to break your bank. It's not going to break your company, but can start to get your feet wet into offering some really good benefits. So that's for people that have employees. All right, so let's kind of wrap this up. When it comes to health-related tax strategies, especially as we come up on year end, we look at self-employed health insurance, we look at a health savings account, we look at a Section 105 plan, and then different various options if you have employees. So with self-employed health insurance, if you are self-employed and you're paying for health insurance out of your pocket, it is a business deduction. Now, how you get that business deduction is going to depend on how your business is taxed. Sole proprietorship, single member LLC, you're just taking that tax, you're taking that deduction on your personal tax return. If you're an S corporation, a couple hoops we need to jump through. We need to pay for it for the business, add it to our W-2, and then take the deduction on our business tax return. If you haven't done that, if you are an S Corp owner and you haven't done that, you need to do that process now. Talk to your payroll provider, make sure you're planning out because you need to do it correctly. We don't just add something to our W-2. There's a specific self-employed health insurance that needs to be added to your W-2. So talk to your payroll provider about that. The second one was health savings account. Again, I believe that everybody, as long as you qualify, should be maxing out a health savings account. And my favorite way to utilize a health savings account is to not spend it. Let that thing grow and grow and grow and grow. Invest those savings, get it into an investment that makes sense, that can grow, and then take the funds out down the road in retirement. Think of it as like a secondary retirement. But if you run into issues, if you need some cash, well, guess what? You can take receipts from those medical expenses that you are paying for out of pocket. You can get reimbursed from tax-free. So it's a really cool secondary retirement option that you do potentially have access to a little bit earlier if you need it. So really cool planning opportunity. Then we talked about a Section 105 plan. This is for business owners with high out-of-pocket costs. Out-of-pocket costs over and above medical insurance, over and above their health insurance premiums. If you hadn't fallen into that bucket and you have no employees, this is a powerful strategy that lets you turn those medical expenses into actual business expenses. Biggest thing with this one, we need to set it up correctly. It has to be got to dot our I's and cross our T's on this one. fairly easy setup once we get it going, and it's pretty easy to manage. Just need to make sure we have it set up correctly. And then if you are an employer or if you are a business owner that has employees, a lot of different options out there. But if you're just kind of getting started and want to start offering a medical option, look into a QSEHRA or an ICHRA. These are health reimbursement arrangements and can be super easy to get going and at least start that process. And then maybe you go into advanced options down the road, or especially as you start to grow, maybe you look to enhance that, but a really good way to get your feet wet. You know, health costs don't have to be the silent killer of your cash flow. With the right approach, from HSAs to properly structuring your insurance to QSEHRAs and Section 105 plans, you can keep more money in your pocket and protect your business. If you found this helpful, don't forget to subscribe, hit that like button, and share it with a business owner who's sick of paying too much in tax. And if you want help from our team of tax professionals implementing these health strategies along with so many other tax strategies, visit taxelm.com. That's TAXELM.com, or click the link in the description for a free discovery call. We are helping people like you legally lower your tax bill every single day. Let's make sure your health expenses become a tool, not a liability. See you on the next one.